This you need to know if you are a doctor, a lawyer, a chiropractor, in construction, anyone that might want to have a brick and mortar office. You have to know the self-rental aggregation election. Your business can pay you rent for this new rental property. You can cost seg it, and that loss can offset your business income.
Welcome to Life Changing Money, a podcast all about one of the most taboo topics in the world, money. I'm your host, Barbara Strehans, and we're going behind the scenes on business owners' journeys to money, success, and wealth. Let's get started.
Hello, and welcome to another episode of Life Changing Money. This week's episode is so important if you're a business owner. I'm going to be talking about the tax strategies you need to build wealth. So I know I talk a lot about write-offs and writing off your life and tax strategies, but there are also certain tax strategies out there that will just build your net worth. And they're things we all need to know about. Honestly, the perfect case study to look at are the Kardashians. There's a reason that every single member of the Kardashian family are worth millions, if not billions of dollars. And do you really think that Kris Jenner would let any of her kids overpay in taxes? The answer is probably not. When we look at the Kardashians, I want you to first know that they pay all of their children. So not only does Kris Jenner have a business and employment for every single one of her kids, but their kids do as well. If you've noticed that Kim has been featuring her kids in her stories, in her product shout outs, in collaborations. And we recently just saw North performing at Kanye's concert. And these kids aren't doing it for free. What the Kardashians are doing is they're actually shifting income from their very high taxed income down to their kids' lower tax bracket, but not just a lower tax bracket. Since the Kardashians are worth more than the estate limit. So if you're worth more than 15, 20 million, even 30 million if you're married, if you're worth more than that, you will be taxed at the highest tax rates when you pass away. And they probably have a trust. In fact, I know that they have trusts. And so their trust tax rates when they pass away is 41%. And so to help lower that 41% tax rate, the Kardashians are shifting income down to their kids so that their estate is worth less, which means they will be taxed 41% less on that money. I'll give you an example that maybe you can understand and apply it to yourself. So let's say that all of us are building wealth every single year, like you should be. And maybe you're buying one rental property every year and you are putting like $20,000 away into your retirement accounts. Well, it might not sound like much right now, but after 10 years and buying rental properties every year, you'll be worth millions of dollars. Now, in 20 years and 30 years when you retire, you will likely be a deca millionaire. And when you pass away, you could be worth tens of millions of dollars. And remember, if you're worth over 30 million when you pass and you're married, that's when the 41% kicks in. So to lower your net worth under the estate limit, you start gifting your kids up to the gifting limit every year. This is something that we do. And in 2026, the gifting limit is $19,000. So you can gift your children $19,000 per parent per child. So that's $38,000 per kid every single year. Let's say you have 3 kids, so you can do $38,000 3 times. Now you just got over $100,000 shifted from your net worth to their net worth. And this is on top of paying your kids. So if we look at the Kardashians, we see them paying their kids to lower their tax rates now, to shift their income now. We're also seeing them gift their kids, which is lowering their estate limits. It's a huge tax strategy, and they have a ton of kids and even more grandkids. So this is really, really smart and a way that they're saving likely millions and millions and millions of dollars in taxes. A lot of people like to joke like the Kardashians are stupid. Like, how did they make money? But the truth is they do every single thing strategically. There is a reason behind every single photo they take. There's a reason behind every single product they shout out. There's a reason they go to every single vacation spot that they go to. And there is a way to make money on it. And there is a way for them to save money and taxes on it. And so just really look at the celebrities because they're the ones paying for really, really good tax help. If we want to keep on the Kardashian train, another really great way that they're saving money in taxes is through real estate. We've seen Kendall, Kylie, and Scott on Keeping Up with Their Kardashians flipping properties. So they're using real estate tax strategies to save in taxes. And I'll tell you just some things that I'm assuming they're doing. Now, of course, I'm not like close with the Kardashians. I'm not saying they are or aren't doing this, but this is just what I'm seeing from the show. So you see every single season, at least one of them are remodeling their house. They're remodeling a second home. They're remodeling their office. They're moving into a bigger office. They're getting a warehouse, or they are flipping properties. And every single one of these can be a tax strategy. So let's look at their primary residences. They are likely, all of them, taking the Augusta Rule on their taxes, which says you can pay yourself for rent 14 times a year and have it be completely tax-free. Now, they live in some of the nicest houses in the entire world, so they can likely charge themselves an insane amount of rent, like $100,000 each time they rent their house out. And they're doing this 14 times. That's over $1 million that they could get completely tax-free and on each one of their properties that they use personally. Now, what they could be doing as well is adding on to their properties. And that would be something like an ADU, a pool house, a casita, an in-law suite, somewhere for Kris Jenner to retire in. And they're making it an office for themselves so that their business can write it off that way. And you can do that too. Let's say you're a real estate agent and you want to have a separate office. Well, your business can pay for the build of the office, the ADU, the pool house, the casita, what have you. We're depreciating that in the business. And then in a few years, when you retire or you close your business, you still have the property on your personal residence and the business paid for it, which is really cool because you just increase the value of your house. And when you sell it later, it could be completely tax-free because of the personal residence exclusion. So we see them remodeling their personal houses. We also see them with second and third homes, which they are likely calling offices. Now, the Kardashians' entire life is on social media and is all around content and videos and photos. And boy, do they eat that up. They are constantly filming in all of their houses. They not only have a show, but they have podcasts. They have social media. And so they're likely writing off those second, third, fourth properties either as retreat houses or as content houses for sure. Now, if we look at someone like Scott Disick, but likely all of the Kardashians are doing it. It's just we're only seeing Scott do it on film. But Scott flips real estate properties. And this is really cool because now he can be a real estate professional. And when you're a real estate professional, you can deduct all of the losses in relation to your real estate and have it offset your other income, whether that's W-2 income or business income. And so he can do that because I think real estate is like his main job. Whereas some of the other Kardashians, like Kim, let's say, she spends a lot of time on Skims. And so she wouldn't be a real estate professional. She could still lose money on paper through real estate with her offices, with the self-rental election, the aggregation election, with short-term rentals, and with flipping strategies. She's just probably not a real estate professional. Now, I'm pretty sure Kendall also flips properties, so she could be a real estate professional unless her modeling career takes more than 750 hours a year. But real estate is a huge, huge way to save money in taxes. Now, I also want to talk about their office space and their warehouses, because if you've seen on the show, they all share a huge entire warehouse. So Skims has an office. Kylie had an office for her makeup company. Chloe probably now has an office for her cloud brand. And so they keep building more and more to their office space. And what's really cool is something called the self-rental election, where your business can pay you rent for this new rental property. You can cost seg it, and that loss can offset your business income. This you need to know if you are a doctor, a lawyer, a chiropractor, in construction, anyone that might want to have a brick and mortar office. You have to know the self-rental aggregation election. It's probably one of the most missed things. But I know I could go on and on about real estate forever, but that's just something you need to know about building wealth, is that real estate is one of the best ways to do that while also saving money in taxes. I'm going to be going over this at our Tax Strategies to Build Wealth Masterclass. This masterclass is for business owners that are making over $200K, and real estate is just one of the ways. So we've gone over paying your kids, paying your family, estate strategies, gifting strategies. I just went over a ton of the real estate strategies. Now I want to go over the entity structures that you have and how creating other entities could save you a ton of money. So one of our clients is making millions of dollars a year. She's so successful and she keeps growing so fast. And so at the end of last year, she ended up having a huge fourth quarter that was unexpected, like millions of dollars in gain. And so what I said is, hey, quickly create a C corporation. And when you create that C corporation, your regular business is going to pay that C corp a consulting fee or an advertising fee, or some sort of arm's length transaction is what it's called. So your regular business is going to pay this new entity for services rendered. And for this particular client, I was like, hey, you're spending a lot of money on ads every single month. So why don't you just prepay all of your ads into that ad company, and that money can pay your ads for all of 2026. Now, let's say she transfers $1 million over to that company, but this can apply to you too. Even if it was just $100,000 or $500,000, you're going to be saving so much money in tax. So your business transfers that money. It creates a big deduction on your regular business. Okay. Now that C corporation, yes, it now has income, but what we do is we create a different year end. So let's say her regular business had a profit of 3 million and she's transferring $1 million over to the new company. So now her profit is only 2 million, right? She just saved like $500K in tax. The new C Corp, that year is now 12/1, so December 1st, 2025 through November 30th, 2026, which means that tax return is not due until the end of 2027 if you do an extension. So we just saved her $500,000 in taxes and gave her an entire year to spend that ad money that she was already going to spend. Now, this works even if it's not for ad money. Let's say you did that and it still gave you until 2027 to use that money. So now you have an entire 18 months to find real estate to invest in to save money in taxes, to find oil and gas, to find other tax advantageous investments for you to lower your taxes. But what it gave you was a longer runway. And so you really need to know, what entity structures do you have now? Which ones do you need to create for the future? Because not only did that save her $500,000 in taxes, but now that she has a C corporation, there are other things that she can use in that C corp to save money in taxes, because C corps can deduct more in charitable deductions than an S corporation or a sole proprietor or a single member LLC or a partnership. It can now have a medical expense reimbursement plan with their spouse and kids on it. So now they get to deduct all things wellness. And this particular client loves the sauna, loves red light, loves supplements, loves anything health and wellness, so that she can be at the tip top of her game. And I'm sure you do too. So it also created that medical expense reimbursement plan. So there's a lot of other things we can do inside of that new entity. So you really have to be talking to your tax strategist about, hey, what entities do I have right now? What are the profits of those entities? Which structures can we create for the future? Because it can build your wealth so quickly. Now, I also want to talk about retirement strategies because so often we invest back into our business. We invest into masterminds. We invest into events and conferences. We invest in our kids and we put them first. But what we really need to be doing is putting ourselves first and to save for ourselves. And the IRS gives you an incentive to do so through retirement strategies. Now, there is something called a cash balance plan where you can put hundreds and hundreds and hundreds of thousands of dollars away into. You don't just have to be stuck with a 401k as a business owner. Your limit does not have to just be the $24,000 a year in retirement savings. You could be putting up to $71,000 away if you have a solo 401k. And please tell me you don't have a SEP because we hate those around here. And we have an entire course about that if you need to know. But you could also be putting hundreds of thousands of dollars away with a cash balance plan or a defined benefit plan. And if your financial advisor is not talking to you about those things, then you need to fire them. And so again, we are hosting a masterclass called Tax Strategies to Build Wealth. And it's a completely free masterclass where I'm going to be going over all of these in depth. We're going to be going over what entity structures you need to have, which ones you need in the future. We're going to be talking about S-Corp election timing if you're not already an S corporation. We're going to talk about all the ways we can use real estate to save money in taxes, retirement optimization, using your family and your kiddos to not only build wealth for yourself, but build wealth for them, build generational wealth. And so definitely join us at our next free masterclass. It's on March 25th. You can just click the link below in the show notes, or if you go on our social media at Your Tax Coach, you'll find the link anywhere in our bio, or if you want to comment wealth anywhere on our social media, it'll send you the link to that masterclass. So thank you for listening to this week's episode of Life Changing Money. And if you implement just one of these strategies, you could be saving tens of thousands of dollars in taxes.
Thank you for listening to this episode of Life Changing Money. Don't forget to subscribe, and I would love if you left a review and shared it with your friends. See you next time.